Hello, I am Edmond Jamna, and on behalf of DW Consult, I want to introduce to you Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, and shaky base in accounting to an expert position and to a place of confidence. It is also a platform to stay abreast in all matters of accounting. Tutorials on the Go is also designed to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as any tertiary accounting discipline. All that is required of you is to subscribe to our channel on YouTube at DW Consult and click on the notification bell to be part of it. Also, like and share the videos by way of inviting others to come aboard. Tutorials on the Go, bringing accounting to heart. Now, today's episode's lecture, Irrecoverable Debts. Now, in this lecture, we will consider what a company should do in a situation where an account receivable does not pay its debt. But I believe you know who a receivable is. That's right, a customer or a client who buys goods or receives services on credit. We'll examine the accounting entries for irrecoverable debts and its presentation in the financial statements. An irrecoverable debt is one which, per a business's reasonable assessment, would not be redeemed or paid, usually at the end of an accounting period. For instance, a customer dying or gone bankrupt, leaving no asset to be sold off to offset the debt, or disappearing without a trace. Although a business is at liberty to take legal action against the defaulting receivable or customer, it is many a times not cost effective, as the cost involved in the court action may outweigh the amount to recover. So let's look at the treatment. It is important that the assets, in this case the receivables, in the statement of financial position is not overstated as held in the prudence concept, and therefore they should only show receivables or debts that a business confidently believes it will be paid or settled. As a result, the irrecoverable amount must be removed from the receivables account and charged to the income statement as an expense in the name of irrecoverable debt. So here, we'll debit the irrecoverable debt, then credit the receivables. Let's test our understanding. Rates Essentials have total account receivable at the end of the accounting period of $50,000. Of these, it is discovered that one, Mr. Forson, who owes $1,000, has been declared bankrupt. And another, by name Ms. Jones, has totally disappeared, owing Rates Essential Limited to the tune of $1,540. Now, we are supposed to calculate the effects in the financial statement of writing off these debts as irrecoverable. Now, let's take a look at the solution. Per the treatment, as we have just discussed, the accounts to be opened are accounts, receivables, and irrecoverable debts, and by extension, the statement of profit or loss account and the statement of financial position. Let's start with the receivables account. We were told that there was a balance of $50,000 standing. Now, a receivables account is an asset account, and all assets have what? A debit balance. So we debit the $50,000. We move on to the entries. Mr. Forson was owing $1,000 and he's gone bankrupt. There's an indication that this money will not be received. Now, this $1,000 is already captured in the $50,000 balance shown in the receivables account. We now have to come and take it off. And per the treatment, we would have to credit the receivables account to lessen the balance. Then we'll come to the recoverable debt account and debit it in the name of receivable. Another, called Ms. Forson, also has disappeared into thin air, owing Rates Essentials to the tune of $1,540. Again, it's also captured in the balance of $50,000 showing or standing in the receivables account. So we come to the receivables account and credit it by $1,540 in the name of irrecoverable expense. Then debit the irrecoverable debt account in the name of receivable by $1,540. So we balance both accounts. Let's start with the irrecoverable debt account. We draw total lines on both sides of the account. Then we find the sums of both sides. The debit is $2,540 against a credit of 0. So we definitely put the $2,540 in the total lines. Then we come to the smaller side, which is the credit, and find the balance, which is $2,540. Then we move it to the opposite side, which is the debit. We come to the receivables account. We do same. draw total lines on both sides of the account, find the bigger of the two sums of the sides. It's $50,000 to the debit and $2,540 to the credit. The $50,000 is obviously bigger, so it gets placed in the total lines. Then we come to the smaller side, which is the credit, and find the balance, which will be $47,460. We move it from the credit side to the debit side below the total lines. After balancing an account, we have to close it off. Irrecoverable debts account, as we said earlier, is an expense, so we have to close it by crediting the account with $2,540 in the name of statement of profit or loss account. Then we place the amount in the statement of profit or loss account. Now the receivables account is a balance sheet item, it's an asset, so we move it into the statement of financial position under current assets column. Stephanie. Now let's move on to talk about irrecoverable debt recovered. A debt is deemed irrecoverable by the entity's estimation or judgment, but there's a possible situation where the debt, which is written off in one accounting period, may be recovered in a subsequent accounting period, in whole or in parts. Let's look at the treatment. When a debt is written off, the double entry is that we have to debit the irrecoverable debt expense and credit the receivable, removing it from the account. When cash is also received from a customer, the normal double entry is that we debit the cash account and credit the receivables account. But when an irrecoverable debt is recovered, the credit entry cannot be taken to the receivables as the debt has already been taken out of the receivable balance in the previous year. So now what do? We have to debit the cash account because cash is coming to the business. Then we go and credit the irrecoverable debt account. Some businesses might also wish to keep a separate irrecoverable debt recovered account so that it doesn't get boxed up with the irrecoverable debt for a period. By so doing, the actual debt written off for a period will be known separately from those recovered from that of the past period. Let's test our understanding again. EDs Limited had a receivables of $3,500 at 31st December 2020. At that date, it wrote off a debt from Ms. Smith of $500. During the year to 31st December 2021, EDs made credit sales of $15,000 and received cash from her customers totaling $14,000. She also received the $500 from Ms. Smith that had already been written off in 2020. Show the effect on all the accounts as at 31st December 2020 and 2021. Let's move on to solve the question. We'll start with the receivables account ending on 31st December 2020. So we're told it had a balance of $3,500. So we'll definitely bring it to the debit because a receivable is an asset account. Then we were told $500 owing from Mrs. Smith was written off. So double entry. We have to credit the receivables balance because it's already contained in the $3,500 balance. Then we'll debit the irrecoverable debts. We will not bring it here. We have to balance off the receivables account. We draw total lines on both sides of the account. Then we find the bigger of the two sides. So $3,500 to the debit as against $500 to the credit. So we put the $3,500 in the lines. Then we come to the smaller side, which is the credit, and find the balance, which is $3,000. Move it to the opposite side, which is the debit. Now, we come to the receivables account for the year ending 31st December 2021. Now, this will begin with the balance on the receivables account for the year ending 31st December 2020. So the balance was $3,000. So we move it here as the opening balance, $3,000 to the debit because it's still an asset account. Okay. So we're told that EDs made credit sales for $15,000. Double entry. We have to debit the receivables account because money was not exchanged. Then we credit the sales account. Now we didn't bring the revenue here because it doesn't relate directly to irrecoverable debt. We need the receivables to show our discussion so far. We're also told that $14,000 out of the $15,000 credit sales was received. So what do? We debit cash because asset is coming into the business. Then we credit the receivables to reduce the balance. Okay. Then we were also told that the $500 irrecoverable debt that was written off in the name of Ms. Smith has been recovered. So we would have to now come and debit the cash account in the name of irrecoverable. Then go to the irrecoverable debt amount and credit it. Now that we are done, what do? We now have to balance and close off the account. Let's start with the receivables account for the year ending 31st December 2021. We draw total lines on both sides of the account. Find the sums on both sides, looking for the bigger. Debit side, which is $18,000, is definitely bigger than the credit into your $14,000. So we put it into the total lines that has been drawn. Then we come to the smaller side, which is the credit, and find the balance of $4,000. Then we move it to the opposite side and drop it below the total line. Let's come to the cash account. Draw total lines on both sides of the account. Then put the bigger of the two sides, which is the $14,500, from the debit into the lines. The credit is 0. The balance will be $14,500. Then we move it to the debit. We finally come to the irrecoverable debt account. Draw total lines on both sides of the account. Then we put the $500 there, which is bigger than 0 on the debit. Right. Then we come to the debit side, which is the smaller side, and find the balance, which will be $500. Then we move it to the credit side, which is the opposite side, and drop it below the total line. Now, of all the accounts, it's only the irrecoverable debt account that is an income and expenditure item. So we now have to come and debit that account in the name of statement of profit or loss item with an amount of $500. So guys, this is where we are going to draw down the curtain. If you have any queries that may require our attention, kindly share them with us via our account using the handle DW Consult on YouTube, Facebook, Instagram, and Twitter. Whilst at that, do well to subscribe and click on the notification bell on YouTube. So we'll come away with another lecture. Stay blessed. Poker.